Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. This week, for a change of pace, when I finished my review of the 7 FANG stocks, I'm going to show you how SVA, that's Structural Valuation Analysis, the name of our methodology, applies to the overall stock market. The overall stock market acts like a single stock. And for those of you who would like to stick around and see what I mean, I'm going to give you a glimpse of the S&P 500 with some discussion of what has transpired and what may well occur in the period ahead. But before we take a close look at the charts, I do want to say thanks again to everyone who likes this video and all our subscribers. Okay, let's take a look at the FANGs now. And the first one, of course, is Alphabet, my favorite stock, and this continues to do beautifully well after breaking out over its MSG price. That's 5.5 times book. And a little setback is just plowing on up to its bubble price, which is 7.4 times book value. What it's going to do after that, I don't know, but let's get there first. That will mean a good win for anybody who followed me into this one. Facebook, the second of the two value stocks among the FANGs, continues to do very well in addition. Now, the company in its quarterly review did warn that growth might stall a bit in the second half. So if that's the case, it could be that the bubble price will be all that is available. Microsoft, well, what can we say about Microsoft? It just continues to flow kind of right along its HB2. That's 12 times book value. Now, the HB2 has been growing at about an 18% rate recently. So as long as it stays stuck to that level, at least you know you're getting some fairly steady growth, even if it's a little bit upsy downsy against that breakpoint value. Now, Amazon. Well, we had a sell on Amazon, didn't we, some time ago? And look at the stock, eh? It came back up to its HB3, but it couldn't make it through. You know, and part of the reason may well be because the balance sheet growth is slowing down a little bit. In this line over here on the right under balance sheet growth data, you'll see that the 5-year compound rate of growth was 45%, the 1 year down to 36, the most recent quarter 9.8, and it's projected for the next quarter only 4.88. The ROE on that company is about 24%, and I'm not sure that that justifies a PE ratio of 61.3 times and a market value ratio, price to book, of almost 15 times. And perhaps what we're seeing here is the market agrees with me. NVIDIA, well, NVIDIA, you know, we had a nice buy on the stock at its HB3, and it went right up to its HB4, which was our target. Now, at this juncture, the stock is selling back and or selling off a little bit, and one wonders why, given the terrific fundamentals of the semiconductor industry. Well, I think that there are two reasons for this. The first one is that unfortunately the market remembers all too well what happens when you get into a similar circumstances we're facing today in the past. What you get is double ordering, inventory hoarding, and so on, and then you get this great boom in the demand followed by a bust. And it looks very much to me, when I look at the semiconductor stocks in general, that they are a little bit nervous that the same kind of thing may be going to happen again. Now, if I look at the longer term view of NVIDIA, the last time that the stock sold off very sharply was in 2018. And what happened there? Well, that was the last time that Bitcoin collapsed. Okay, remember? Collapsed down to about $3,000. Well, it's up at 55 or 58, wherever it is today. Frankly, who cares? Except, of course, that the demand for NVIDIA chips for Bitcoin miners is, or has been anyway, very strong. If we have another rollover and collapse of Bitcoin, I think you can look for a big setback in the stock. I'm not, of course, forecasting that because I don't forecast Bitcoin, but I'm just saying some people are thinking that Bitcoin may be rolling over. In that case, watch out. NVIDIA could have quite severe downside risk. Netflix, well, you know my feeling on Netflix, which I have had for a long period of time. I'm afraid that this is a company where the competition is heating up, and indeed, even though in their latest quarter they beat expectations, doesn't mean a thing, because in point of fact, what the market looked at was the rate of growth, and the rate of growth was slowing. Well, what's happened lately is that the stock has broken below its HB3 price now. Given the fact that the fair market value over here on the right is 62% below the current price, if the market gets really concerned about the growth of this company, it could be a long way down. And you'll remember, by the way, some while ago, I think I spent 2 of these FANG Fridays talking about the potential downside risks of Netflix. So any of you who are new to this may actually want to look them up and see what we said. It is quite fascinating and a bit worrisome if you're a holder. Finally, Apple. Well, I mean, what can we say about Apple? They had absolutely spectacular numbers. However, the CFO of the company warned of a sequential decline coming up that is steeper than usual. Projected sales of the company are actually only plus 4.2%. And part of that's due to weaknesses in services and also some concerns that there may be some margin erosion in the App Store. So this is a case to be a little bit cautious of. Today, the stock actually has rebounded almost right up to its HB5, so we don't have a confirmed breakdown, but watch this very carefully. In summary, to cut right to the chase, Alphabet, Facebook, and Microsoft are safely in what I would call my phantom FANG portfolio. Amazon has not been able to get back in yet, as it has failed to advance above its HB3. NVIDIA met our upside target and is setting back now, while Netflix has actually given us another sell signal. And that leaves Apple with great immediate numbers, but no apparent follow-through coming, with a potential sell signal. But we'll have to wait and see right now. Now, I promised you a look at one of our index charts, and now I will now show you what the Standard & Poor's 500 looks like from our eyes. Now, clients watching right now will recall we discussed this during the weekly client webinar on Tuesday, where you also got to see the TSX and the NASDAQ 100, which gave us tremendous signals that we can all now see clearly. And while we're on the subject, clients who are watching right now, we have published this month's market letter where we further discuss the charts that we do not show here. So take a look if you have not already. It's on the client website. In next week's client webinar, we will be building on this, so you'll want to attend. Now, a word about the stock index charts. First and foremost, the market acts like a single stock, and this then helps you enormously with your overall market timing. When you use all three of the North American index charts together, you therefore have a remarkable overview as to the direction, the magnitude, and the potential of the impact of the stock market on your portfolio. So let's take a look now at the S&P 500. Okay, so here we have a look at the Standard & Poor's 500, and what I'm going to do is start off with a look at the bottom of the market in March 23, 2020. And you can see here that little spike carried right down to the growth price, which you can see in the right-hand column there. It bottomed there perfectly, and some of you may well remember that a week before that, when I was on with Anita Sharma, I pointed out that I had projected that the bottom would come at 21.75. The cash market bottomed at 21.91, but the futures market bottomed at 21.73, dead on where we thought that it might. Well, subsequent to that time, there has been a nice rise in the market. In fact, it broke out. That next break point there is its super growth price. It got up there and has broken out recently. Incidentally, the S&P actually was led by the NASDAQ 100, which broke out at the same time that the market was reaching its super growth price for the first time. So we've now got a nice breakout. Well, the upside target now, as I've said to you before, stands at about about 4,000, or sorry, about 5,000, right on which you can see on the left-hand side there. So there would still appear to be decent upside potential in the market at the present time. Now, there are a lot of people who are looking for a setback in the stock market. I would have to say, when I look at all three of my market charts, the S&P 500, the NASDAQ, and the TSX, the downside presently is fairly limited. And therefore, I am rather much more on the optimistic side than on the pessimistic side at the present time. Anyway, clients who've been with us remember these moves clearly, as we call them, much like we did the bottom in 2020. And now the big question is, what lies ahead? Anyway, I hope that you haven't minded if I've taken this little foray into the wider view of things. And in any case, next week I'll be returning to our usual format. For now, this has been Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates, reminding you that nothing, including the market, is difficult if you have the right tools. I'll see you next Friday.